Speculation is everywhere. What to do when the music stops? Plus, if the reopening trade is faltering, where can investors find returns? For all this and more, I'm joined by Jared Dillian of the Daily Dirtnap. Jared, how are you doing?
Doing pretty good. Thanks. Glad to be back here again.
Yeah, well, I'm glad to have you back. So, Jared, the timing today was great because you wrote a piece in Bloomberg Opinion, and I'll read the title. Dogecoin symbolizes the conundrum facing investors. What did you mean by that?
Well, the first thing you should know about any article you see, not just on Bloomberg or anywhere, but the author of the article doesn't write the headline. So I didn't write the headline. But the the article itself is basically about this idea that, I talked about the Chuck Prince quote, back what he said in 2007. And somebody asked him how long Citigroup was going to be doing mortgage stuff. And he said, well, if the music's playing, you have to keep dancing, And one of the reasons that is that all your competitors keep dancing. You know what I mean? And employees are making money. So there's just all this pressure. It's much bigger than one person, one person can't stop and say, okay, this doesn't make sense anymore. It's all about reflexivity. So the question is, as an investor, how long do you stay invested? Because it's kind of like picking up nickels in front of a steamroller. There's a lot of signs of speculation. There's Dogecoin, there's SPACs, there's all kinds of stuff. So how long do you stay in this trade before you pull the ripcord? And, it could go on for another 5 years. We just have no knowledge of how long this is going to go on. So you just kind of have to play along and be nimble so that when it turns, you can get out as quickly as possible. That's what you're supposed to do.
And Jared, as you prepare your portfolio and those of people you advise to be nimble, what are you looking for in terms of the sentiment in the market? Do you see the signs that something is turning now? Because the speculative juice has been drained a little bit out of the SPACs. Obviously, crypto has remained very firm. And we have this new phenomenon of Dogecoin, which some are saying is kind of the GameStop moment for crypto. So how are you reading the different risk appetites? What would Chuck Prince do at this time?
Yeah, I'm very tuned into sentiment, and the market stocks are up today. They were down the last 2 days, not a lot, just 100, 150 basis points, just a small pullback. I don't really see sentiment as being really, really frothy or max bullish right now. Back when the GameStop thing happened a couple of months ago, I freaked out and I sold anything to do with tech. I think we talked about it at the time, and that to me was like the peak of sentiment, and I think we're sort of at a lower high right now. So I'm not really seeing any really big warning signs that, a correction is imminent. The last two times in history that I've really gotten that feeling were before the pandemic, when the pandemic hit right when everything was max bullish, and also before the vol explosion of 2018. Those were two times where my antenna were really up, sentiment was just pegged. But it doesn't feel that way to me right now. I actually feel like we have some more upside.
Jared, let's get into the varied asset classes that you mentioned. You say, when I look at Dogecoin, I look at SPACs, I look at Tesla, GameStop, and other signs of a bubble. The one thing that ties them all together is interest rates. If rates rise, these trades will implode as leverage is unwound throughout the system. That was a catalyst earlier in the year, as you mentioned, Jared, when those interest rates rose, we saw a huge dump in the Teslas and the Pelotons, all those very long duration stocks, let's call them. Yep. Since then, they've sort of leveled out, with a few exceptions like Teladoc, but they've leveled out as rates have remained in a range. How do you think that bond yields will impact that long duration sector of the market going forward?
I think we're definitely going to get round two of this. I mean, rates are consolidating right now. The bond market is, I'm not really plugged into the technicals of the bond markets. I don't know what the Japanese are doing. I don't know any of this stuff. But just from a technical standpoint, rates seem to be consolidating. But we're going to get another push higher in rates 3 months from now, 6 months from now, maybe a couple of quarters. But that next push higher in rates is coming. We're going to be printing inflation numbers over 3%. We're going to get some scary CPI prints. So that's going to happen, and we're going to get round 2 of this duration sell-off in tech and biotech and stuff like that. But that's probably 3 to 6 months away, I think.
Jared, paint me a picture of what would have to happen for alarm bells to ring in your head and say, actually, I'm going to pare back risk. Perhaps I'll even take a stab at shorting some of these long duration names like you did in January, late January, early February. What would have to happen for you, for those antenna to go up for you?
I mean, it would have to be something like GameStop, like something with that sentiment significance. But it's, I think that's going to take a while to develop. The GameStop was a big one. That was a really big one. I mean, if you go back to that period of time about 3 months ago, we had 40 million call options trading in a single day. Like, it was absolutely bananas. And, people were trading options in GameStop. GameStop implied vol was like 1,000. It was nuts. So we're not really close to that right now.
Yeah, because you mentioned implied vol, do you think options are fairly priced, overpriced, underpriced? Because the VIX remains in the teens, and options, are quite cheap as they compared to, let's say, at the beginning of the year. So, what's your outlook on implied vol? Is it overbid, underbid?
I actually think it's a little rich. I expect it to go down a little bit more. I think that the market is kind of clogged with a lot of long option positions. The VIX spent an entire year above 20, and there was a lot of realized vol. And I think people got accustomed to this high vol environment. And now I think there's a lot of pressure on vol as people exit those positions. So I wouldn't be surprised, for us, let's say the S&P grinds higher another 5 to 7% and the VIX gets down to like 14 or something like that. Like, that seems possible.
Okay, Jared, let's move on to the reopening trade. This is something you've been banging the drum about for a long time. It worked extraordinarily well up until, let's say, 2 weeks ago. We've had a little bit of a falter there. In fact, I did a little back of the envelope math that over the past 10 trading days, so 2 weeks, there have been 14 stocks that were down less than 10%. And 8 or 9 of them were classic reopening stock. I'm thinking airlines, I'm thinking an oil stock, cruise liners, Live Nation, a concert stock. So the reopening trade to me, and by the way, a fair number of them were Archegos trades like Discovery and Viacom, which so they really shouldn't count. So how are you thinking about the reopening trade? It worked very well. But it's faltering a little bit now. Are you moving out to other positions? What's your view?
So basically, I have 3 reopening trades. One of them is Delta Airlines, which I'm exiting. This is kind of for reasons that are specific to Delta. But when I entered these trades 3 to 6 months ago, the reason I entered these trades, what I said to myself at the time, that the reopening is not fully priced in. And back when I entered these trades, it wasn't. And now my fear is that it is. I saw that the airlines are expecting that this summer travel is going to be 90% of what it was in 2019. So when you start seeing stuff like that, then that's in the collective consciousness. Like, that's basically, that means that it has to exceed that in order for the trade to work more. So I think it's time to start exiting the reopening trades.
Okay, and by the way, I believe based on your newsletter, you formally put out this position last night, and it happens today that the IATA, that the transport thing that represents all of the carriers, today they put out a release saying that they expected their carriers their airlines, meaning to lose $48 billion this year, and that was an increase from $38 billion loss that they projected in December. So your timing was pretty good.
Yeah, that's pure luck. That's just pure luck. So,
yeah. Okay, so you have the airlines. You're exiting those. How are you feeling about your other reopening stocks?
Well, one of them is a theme park operator, and there's only 2, so you have a 50-50 chance of getting it. So that I'm going to hang on to a little bit longer. I've been hearing some stuff from people that parking lots are absolutely full, like they're jam-packed with people. So I'm waiting to see 1 or 2 more earnings out of that to see if that works. And the other one is, which we've talked about on Daily Briefing before, is SL Green. Um, I bought SL Green around 60. It's up around 71, 72, something like that. Not, I would say, not a huge winner or anything, but I like owning real estate and I like getting the income. I've never been super comfortable with this trade because I'm not comfortable with New York City governance. I'm not confident that it's going to improve after De Blasio is gone. So I really have an itchy trigger finger on this trade, but I plan to hang on to it for a little bit longer.
I'm glad you said you had an itchy trigger finger. I want to get into that because I saw a report, just a chart from Bloomberg today that year over year rents in commercial New York real estate, so like Soho, Herald Square, Madison Avenue, are down considerably, and this is not surprising, of course, given there's the pandemic. So Soho's down almost 20%, Herald Square, 19, 18%. What is your outlook on this sector? Does it depend on a true boom, a flourishing, a roaring 20 of everyone putting their suits back on, going back to the office, or is it more of a safety play, saying the contracts are ironclad? It's impossible to get out of these contracts if you are leasing them. So it's kind of free money. What's your outlook?
Well, it's kind of both, but it's really the first one. When I put on the trade, occupancy rates were around 10% for SL Green. And I put on the trade with the expectation that they would get up to 40 or 45% by the end of the year. I think this is going to take a long time to play out. I'm not a believer that because of the pandemic, that everybody is going to be on Zoom working from home. I think incrementally, yes, there is going to be some more working from home, but I do think, for certain industries, especially finance, you want people back in the office. So I do think that occupancy rate is going to go up. It's just going to take some time.
Yeah, definitely. If you're an insurance salesman, you definitely want to be across the table from the other person. It's hard to do that over the phone.
Yep.
Okay, so that's good on the reopening plays, but you're now transitioning your portfolio to a more direct exposure to reflation rather than just reopening in terms of activities. You're really targeting inflation. Really with your you got your target on that. So tell us about that. You think inflation is coming. How are you positioning your portfolio to benefit from inflation?
Well, it's funny because in my newsletter today, I published the portfolio, which I do about once a month. And I had a subscriber up in Toronto and he emails me and he's like, Jesus, he's like, this is a big bet. Like, I mean, the whole portfolio is dependent on the inflation trade. So let's just say, for example, Lacey Hunt or David Rosenberg is right and bond yields go down and we have deflation. I'm screwed. Like, it's bad. It's really bad. Like, this is a big bet. And one of the positions that we added last week or 2 weeks ago, which I'm comfortable sharing, is the new inflation ETF from Horizon Kinetics, which has a lot of commodity streamers and exchanges and stuff like that, but all stocks that have gearing to inflation. I really like that ETF. I'm going to do some more work on it. So that's a big position in the portfolio. But yeah, I think this is a 10-year theme, and it's funny because on Monday and Tuesday we had a pullback. And we haven't really had a meaningful pullback. We even haven't had a slight pullback. Like the biggest pullback in the last month was like 80 basis points. So you have this pullback, and then you do this whole psychological thing. You start questioning yourself, like, oh my God, like what if I'm wrong? What if this is the wrong trade? And I keep seeing signs of this everywhere. I went down to there's a place called the Bagel Factory here in Myrtle Beach. And it's a guy from New York who actually used to work in my building. He used to work in the Lehman building. He had a courier business. And he opened this bagel place in Myrtle Beach. And it's great. It's like New York bagels. But they put a sign up and they're like, yeah, due to increased costs of, bread and rubber gloves and all this stuff, we have to increase our prices. Seeing that everywhere, absolutely everywhere. So I'm still confident in the thesis.
Absolutely. I saw Coca-Cola had a similar announcement. But Jared, you mentioned Lehman Brothers, and that makes me think of your newsletter. You noted how you didn't invent the word piker, but you did popularize the use of the word piker at Lehman Brothers. Can you explain what a piker is and what sort of trades you associate with that phrase?
Well, a piker is a cautious gambler. Okay, that's the technical definition. And when I started working at Lehman Brothers, I had a very distorted perception of risk. I was coming from the military, I was coming from the Coast Guard, and the sea services are known for being very risk averse. So I was a very risk averse individual. So I used to trade futures at the time, and I would not go any bigger than a 10 lot of S&P futures, which was a 50 lot of E-minis. And you could like trade 10 lots of futures. This is the pit traded futures. You could trade 10 lots of futures, and if you were good, you might make $20,000 or $30,000 in a day. That just does not change the shape of the earth. That doesn't do anything. So over time, I had to increase my risk tolerance, and it was an effort, but I started trading bigger and bigger and bigger, up to the point where I was trading, 10 or 20 times the size I was before or more. So.
Right. Okay. And you identified several different positions with that phrase of being a piker. And there was one position you said how you really regretted not sizing it up. Do you have any advice for people listening about when to know when to go small on such a piker position or when to really size up?
Well, position sizing is the hardest thing to get down. It really is. I mean, the decision of what to buy is pretty easy. The decision of when to buy is pretty easy. So the decision of how much to buy is the hardest. And there's a lot of different considerations that you take into account when you're sizing a position. The biggest one is conviction. How sure are you on the thesis? So the stock that you were referencing, I don't own it anymore, so I don't mind talking about it. It was Vulcan Materials, which is an infrastructure stock. It makes asphalt. And this was back leading up to the 2020 election. And I said, gosh, no matter who wins here, we're going to get infrastructure after the election. And if Biden wins, it's probably going to get more. So he won. And that was pretty much a sure thing. That was an easy trade. And I made it 1% of my portfolio. And and I'm really, really sorry that I did not make that bigger. So I find, I'm a piker. I'm a very cautious gambler, and I tend to undersize positions. And look, there have been situations where I have had lots of conviction and I've made a position really big, and it's turned out to be wrong. That's happened one or two times. So it is the hardest thing in the world.
Definitely. Well, thanks for sharing that insight. Jared, the next thing I want to talk about is a chart that you featured in one of your recent newsletters about the CPI and how the various products trade within that. So it's the stuff that you need to buy all the time increases in value a ton, but the stuff that you don't need to buy often, that's the blue line, actually experiences deflation. So can you experience how that factors into your thoughts on inflation and how you're positioning your portfolio?
Yeah, I got that chart actually from Stock Cats, the guy on Twitter, and he has a lot of cats. I have a lot of cats, so I feel a connection to this guy. He puts out some pretty good stuff. It's funny because we have CPI X food. Food is ripping. We have CPI X energy. Energy is ripping. Maybe we're going to have CPI X lumber, So we keep carving out all these exceptions for inflation. And food and energy are the stuff that you need to buy, and that's the stuff that's going up. So it's, yeah.
There we go. Could you tell us a little bit more about your other plays that are leveraged to inflation that we haven't mentioned, such as oil?
I've had a position in energy going back to, it was before the pandemic. And I was definitely early, let's put it that way. And I made the position very large. If you remember the day that the Saudis and the Russians both started pumping and oil crashed like 10%. I literally had made the position very large the day before that happened. The timing was exceptionally bad, but it's actually up quite a bit since then. And oil is around $60 right now, and it's consolidating. And I do think that oil is going to go to 100 probably within a year. I do think that I think that's going to happen. So it's just a matter of having patience at this point. It kind of sucks a little bit because energy is volatile. You're up and down 3 or 4% a day. You have to withstand some volatility. But I do see a lot of upside in energy.
Any thoughts, Jared, on the futures curve of crude oil, which is in backwardation now?
Well, backwardation is usually bullish, and that's the extent of my thoughts.
All right. Jared, let's move on to tech stocks and earnings. Yesterday, after market close, Netflix posted some earnings which were received very negatively. Subscriber growth well below what was priced in, what people were expecting, and that it is largely due to people going outside, driving their cars, not being inside. As we approach earnings seasons, we already had the banks, we had Netflix yesterday, Tesla, Apple, the big tech stocks report next week. How are you thinking? What are your expectations of the results that they are going to post, and how the market could potentially react?
Well, first of all, let's talk about Netflix first. The subscriber growth miss was a function of, things opening up and stuff like that. But it's also a function of the fact that Netflix is just getting saturated. Everybody has it. And I've kind of been waiting for this to happen for a long time. And you saw my tweet yesterday where I was very sorry that I didn't have a short position going into earnings, because that seemed, in hindsight, it seemed very obvious. And of course, Tommy Thornton, my friend Tommy, weighs in and he says, yeah, I was short, Of course, he's short all the time. So, Netflix. It's kind of a weird animal. Like, they're becoming more saturated. They pay billions of dollars a year for content, which is debt financed. Like, that's what makes Netflix unique as a tech company, is that it's debt financed and it's high yield, So it's pretty fragile, and if you look at a chart of Netflix over the last 2 years compared to the S&P or other tech stocks or whatever, it's underperformed. So I tend to think that Netflix it might have hit its all-time high. I think it might be done at this point. So I think going forward, I'm going to be looking for opportunities to short that or play it on the short side. As far as the other tech stocks, I don't keep track of earnings, so I don't really have any expectations of what earnings are going to be next week. No ideas at all.
Okay. But how are you thinking about the tech stocks in terms of trading them? Because I know that earlier this year, as you expected bond yields to rise, you were leaning into some puts on Facebook and Tesla. And Facebook, I think, did well, but Tesla, that stock absolutely dumped. So I'm sure that was a huge trade for you. Are you looking to do that again, or are you sort of like, we're in this holding pattern, I'm going to stay on the sidelines?
No, I think I'm going to sit this one out. We may get another opportunity on the short side in tech, and I think that there's going to be a big convergence between value and growth, and value is going to outperform and growth is going to underperform. So I think there's going to be opportunities to play this on the short side, but I'm going to sit this one out in the near term.
You're going to sit this one out, but you're going to keep dancing.
Yeah. There
we go. Jared, one of my final questions for you is about the ultimate inflation play, which is, of course, gold. When inflation rises, this thing goes on an absolute tear. But when you have a somewhat disinflationary decade, or a low inflation decade like we've had the past decade, of course, it doesn't perform as well. You have a very interesting chart that was in one of your latest report called "Speculators Have Abandoned Gold." Tell us, what's your outlook on this that sort of reemerged from its cocoon? What's your outlook on gold?
Yeah, gold trades very technically, and if you go back to the early days of the Biden presidency after the election, when we're talking about massive amounts of stimulus and massive deficits, there were all these gold bullish catalysts and gold kept going down. And eventually it kind of exhausted itself. I do think there's a lot of gold shorts out there. I haven't looked at the commitment of traders in a while. I do think there's a pretty decent short position. So now gold is up about $100 off the lows, and it's going to run into trendline resistance around 1850. But if it can get through 1850, we're gonna see the old highs. So.
Jared, I recently conducted an interview with a real estate developer who, like you, thinks inflation is on the horizon and that it's coming big. He split his bets between gold and Bitcoin. There were some people who loved gold who said, what is this guy doing with Bitcoin? And there were some Bitcoin people who said, why is this guy even buying gold? What does that have at all? I know Bitcoin, you viewed it as a trade. You exited that trade earlier this year. Since then, Bitcoin's been up, but we've had a little bit of a reversal. And as we had that relatively large dump, relatively large drawdown over the weekend, up to about 15%, that is, of course, when Dogecoin surged. So I know crypto is not a space that you follow super closely, but I mean, you did say, and it's not your title, but you did say that this Dogecoin is emblematic of the speculative fervor in this market. So what is your outlook on that space?
On crypto in particular?
Yes.
Well, I'm just going to throw out kind of a wild theory. And, in the last month, you saw India moving to ban Bitcoin. You saw Turkey moving to ban Bitcoin. And there's another country too. I can't remember what it is, but there's 3 countries that are looking to ban Bitcoin. And and obviously you can't ban Bitcoin, but nonetheless, it makes it a lot more difficult to transact, and people don't want to take that risk. So one of the things I said in my newsletters was that Bitcoin is going to get banned a lot longer before gold, right? Like that's definitely going to happen. Gold, in terms of a store value, like if you have it in physical form, it's off the grid. Like nobody knows you have it. I mean, you can take it and put it in your wall behind the studs, and like nobody has any idea that you have it. Bitcoin is traceable. So, when it comes down to that real like off the grid disaster store of wealth, I still like gold. And not to say I won't get involved in Bitcoin at some point in the future. I'm always leaving that door open. But I think that just what India and Turkey have done might be partially responsible for this reversal between gold and Bitcoin in the last month.
Jared, our friend Tony Greer was on Real Vision, the Daily Briefing yesterday, and he said to my colleague Ash that if Bitcoin had a huge a sell-off, let's say down to 30,000, that would delight him because he would, that would be a buy opportunity for him. Would it be a buy opportunity for you too?
I agree with that in principle, but I think we have different levels. I think it has to go lower than that. I think it has to go between 10 and 20,000. Basically, if you look at Bitcoin historically, it'll routinely have drawdowns of up to 80%. It happened the last time when, what was it, 2017, it got up to 19,000. And then during the pandemic, it got around 4,000, 80% drawdown. Like, I think it would be a little bit premature to get back in at 30,000.
And Jared, sorry to bother you with this, but what do you think about the tremendous surge in Dogecoin? As you wrote in your piece today, the currency, probably not right now, but there was a time over the past 2 days where it had a greater market cap than Ford Motors. And I actually did a calculation, greater market cap than Walgreens at perhaps during a few hours. So what does that say about our financial economy?
Yeah, it's like I said in my Bloomberg piece, it's not the first time that I've seen people bid up something that was totally worthless. It happened to .com stocks in 2000. The difference with Dogecoin is that it's designed to be worthless. It literally is a joke. And like a lot of crypto, it's an early bird game. So if you buy before everyone else and you sell before everyone else, you make money. And it has characteristics in common with the Ponzi scheme. In that respect, it's kind of like a decentralized Ponzi scheme. So it's an object of speculation. That's all it is. It's an object of speculation, and it's a proxy for risk. And if we have risk off in the markets, then people will lose interest in Dogecoin. I can tell you that.
Jared, I'm going to ask you a question, and there are two options. You have two options. You have to go long Dogecoin or short Dogecoin. Obviously, what you want to do is do nothing, but that's not an option. You have to go long or short. What's your call?
So you're putting a gun to my head, and you're forcing me to go long or short Dogecoin.
I didn't want to say it and be so impolite, but yeah.
I would say short.
Short. Very interesting. Very interesting. Well, with that, a powerful ending. We'll have to leave it there. Jared, thanks so much, as always.